it's not being greedy. It's ultimately you have a responsibility to optimize. When we look at rent growth scenarios and rent is going up like it has over the last few years, especially during COVID, you're not just like it's an option. In some ways, you're really kind of obligated to push rent because your cost is going to be going up, whether you like it or not. You can not push rent. We've often got scenarios as well where we're working with property owners and they end up with these massive bills around deferred maintenance. And we're like, you're going to have to fix a lot of this stuff. Like this stuff isn't up to where it should be at. It's like, well, we haven't really been able to afford to keep our property up. And I'm like, well, it's because you're not at market rent. There seems to be a correlation in that regard.
Andy, thank you for joining me for our Thought Leader Spotlight series. I'm your host over here, Matt Kamp with DealMachine. And on these, we really like to shine an industry spotlight on experts like yourself, hear your inspiring stories and how you see the real estate landscape evolving. So today, really excited to welcome on my good friend, Andy Talbert. We've been friends for a long time, man. Excited to finally have you on. I know you've been in the real estate space for over 15 years now, focused on acquisition, capital formation, development, brokerage, property management, all kinds of different experience there. You're a managing partner at the Elux family of companies, a lot of build for rent, a lot of multifamily. So we have a lot of things there we can talk about. And I know in general, you're just a big believer in the continued need for housing supply in the US and just the power of real estate and how it pertains to wealth creation and preservation. So Andy, excited to have you on, man.
Thanks so much, Matt. It's always a pleasure, and I'm excited to be on as well.
Yeah. So to kind of kick us off, I know I touched a little bit on how long you've been involved in the space, but can you tell us more about your personal real estate journey and then Elux as well? Because I know you guys have continued to evolve, continue to add things that you can really bring more value to people in a variety of ways now.
Yeah, no, it's got to be true of the real estate business. It forces you to kind of continue to learn and change and evolve, obviously, with the markets and the changes and the needs. I didn't come from a real estate background, so I didn't kind of have the traditional path. I didn't go to school to study real estate in any way or whatever else. I kind of just studied more general business. I ended up working for a couple corporations, including Hallmark Cards in Kansas City for a few years, and right out of school, and realized kind of along the way that I wanted to kind of find my own path, and discovered kind of the widget, or if you will, or the asset class of real estate along the way. Started kind of working in some syndications, some apartment acquisition, started to learn about underwriting and how things worked and how family offices chose to invest and how syndications worked and all these kind of various things in my late 20s. It wasn't like I started right out of school and kind of figured this out. I had some other kind of business experiences along the way. And before I left Hallmark, I had gotten to the place where, I'd had a few deals that I'd been able to be a part of and realized that I wanted to dedicate more time and focus towards real estate. And that involved kind of a path that led towards figuring out other functions within it that, ended up including development, including, new ground up construction, and discovered kind of the widget, if you will, of build for rent, or what became build for rent or build to rent, which is really mostly communities of townhomes, single family rentals, those types of things, which is a bit of a subset of multifamily, and realized how powerful that can be for individual investors, for groups, and the more appetite that was kind of evolving in the marketplace in that regard. So Elux kind of stumbled across or upon, I think, this whole build for rent phenomena as much as anything else. I looked at it, I think, a few years ago and realized the people who were doing apartment complexes, who were kind of building out these big communities, they were well capitalized. They had a lot of experience. They had really, really long resumes in a lot of cases. And the people who were doing, this smaller type stuff, if you will, in a very real sense, there wasn't nearly the level of competition. There wasn't nearly the level of efficiency. And so because it was, intrinsically inefficient, and the barrier of entry was a little bit lower, it provided opportunities for people who were new to the space. It wasn't necessarily geared as much as other asset classes towards just the incumbent always winning. And I think because of that, we were able to get some traction early on as an upstart. And, I don't think any of us could have predicted, obviously, COVID and some of the various other things that have happened that have really pushed, the need for, single family rentals or townhome rentals, outside of the apartment world. But it's grown, and I think ultimately we believe in it as a long-term trend.
Yeah, I mean, you touched on it a little bit at the end there, but I think just the whole idea of build for rent or BFR for our audience is might be pretty new. It's something that, it's gotten a ton of traction lately and grown a crazy amount in the last few years.
Yeah.
But Can you maybe talk on that from a macro level a little bit more for our audience on why this space is growing so much and kind of your guys' philosophy to it?
Yeah, I mean, I think for anybody who's kind of in the space, whether it's scatter site or what's called scatter site, value add, anything like that along the way, build for rent is another iteration of that. And I think most of our recent history obviously goes back to kind of the great financial crash in 2008 and how much that really kind of reset the table. One of the big things that came out of that is you had banks that just owned a whole lot of single family houses. And banks don't like real estate, and they really hated single family houses, right? So they had to figure out kind of how to unload those. So there were groups that spun out of Wall Street that ultimately figured out that you could actually take these single family homes that historically people just thought of as, you got to get somebody who's a buyer who can get a 30-year mortgage and live in this thing, and turn it into a rental, and make it somewhat more efficient than maybe had been done in the past. So I think you see from like 2008 to maybe 2010, 11, 12, you see a lot of that where the banks were just unloading these single family rentals they had taken back. And companies like Invitation Homes and others were born out of that moment. They, I think, then realized as well on the institutional capital side of things that this actually was a viable business. It had been proven out kind of through this crisis and through this storm. It wasn't probably on purpose. And then the need became, well, we need more of this, and we can't just going to go acquire it all scatter site. So how do we do it? How do we build it? And so I think you started to see companies like our own pop up where you realize you could actually take and you could build an entire community of 50, 100, 150 homes, and you could take them all rental. You didn't have to sell them into kind of the just general owner occupant for sale market. So I think that's really where build for rent kind of has come from. I think the evolution has really been on the product type. We've seen it get bigger. We've seen it have more bedrooms, more space. A lot of the product that we're building, especially in the Midwest, is 3, 4, even 5 bedroom, 2-car garages. I mean, these are the types of homes you would drive through that would be just very suburban, very normal type of a neighborhood in a good school district. You would have no idea, other than the fact that who lives in them, that these people are renting them and they're tenants, and they're not actually the owners of the properties. But it's still a very, very great experience, I think, for the people who are able to be tenants in these types of communities. So the way I would define build for rent or build to rent, I don't make a huge distinction between the two, just from a terminology point of view, is purpose built residential housing that is designed and built for the purpose of rental, and to be professionally managed like you would expect like an apartment complex to be professionally managed. So you can look at the whole of the market size wise, and there's about 15 million roughly single family rentals total within the United States. A small subset of that are what are considered build for rent, right? They weren't homes that were built to be sold and then traded multiple times and then ended up turning into rentals. They were homes that were from the ground up, built with the intent and purpose of being rentals over the long haul.
Yeah, that's. I mean, I think it's a super interesting approach for a lot of people on here. It's something. I was always curious if you're somebody who's like newer into the real estate space, kind of getting your feet wet on maybe the wholesale approach. Maybe you're building a small portfolio. You're really focused on the single family side. Is there a pathway into that built for rent space that you recommend for people, like if they're interested in that approach? How do you kind of see that being approachable for somebody who's maybe a little bit newer to it?
For sure. No, I think, again, I think, I mentioned before, we came into this space as an upstart. We didn't come in as an incumbent. We didn't come from a really, really deep capital base in any way or whatever else. And we have found tremendous opportunity in the space. When we look at a community, for example, whether we're developing 50 houses or, 250 houses, we know that the intent is to build really, really good product that is needed in the marketplace, and so, I talked about, most of our product being 3, 4, or 5 bedroom. That's what makes it different than apartment, right? Apartments tend to be studios, 1s and 2s, and maybe a few 3s here or there, right? So we intentionally try to not overlap with the world of apartments and multifamily as much because we think it's a distinct experience from a tenant point of view. Obviously, it does overlap with the single family rental space. It's part of that in the whole of it. So whether someone's wholesaling, whether they're looking at value add, whatever strategy they might have, they might even be looking at teardown. Obviously in a lot of these hotter marketplaces, over the last few years, the Nashvilles and the Austins of the world, there's been neighborhoods where, you'll kind of see just, a handful of, 1940s, 1950s, 1960s houses, and then, monsters being built on the block, if you will, based on teardown. So, a lot of these kind of opportunities can be sized very, very differently. We like the asset class of single family because it is more bite size, right? You can do one or you can do 10,000. I mean, there are groups that do each of those two things. A lot of our communities we've taken in the past and we've bundled up and we've kind of said, okay, this is maybe an institutional buyer for this or a large family office that wants to take the entire community. But more often than not, we've actually, because of the fact that they're individually platted and we choose to have that optionality, taken and sold them turnkey to individual investors, that might be part of, a very common one we have is, groups of doctors or groups of, of kind of white collar professionals who want to do real estate investment, but they don't prefer to maybe be a part of a larger syndicate. They prefer to kind of control the assets in some way more directly. So they're able to go and, buy a group of single family rental homes that are built for rent. And then potentially, a few years down the road, take it, sell the portfolio and 1031 into something else. So we love the optionality in the space. We love how bite size it can be in terms of how, you've got a certain amount of money to place. Cool, you can find something that's a fit, and I think obviously for new construction, it tends to be a little bit upmarket from maybe some of the older stuff, but it's still, in terms of overall dollar amount, significantly down market from going and trying to buy even a small apartment complex, for example. So, really, I think there's something for everyone in the space, and just figuring out kind of how you get a foothold in the space is very, very important. But, we believe in the asset class of single family, and we think that the new purpose built part of that asset class is also a very, very important part of it.
Yeah, I love how you guys have evolved, not just from that piece of it, but also into the property management side. And really, I know we've got a ton of people on our end who, again, they might be wholesaling, might be flipping, but are either building a portfolio or intending at some point in the future to be doing that. Can you kind of talk about the gap in the market you saw there, the opportunity when it comes to property management, and how you guys are approaching it differently?
Yeah, absolutely. I mean, I think if you really think about property management, the default position is, apartments, right? Like in terms of the world of residential, apartments are what are the more common asset class to be rented out. So because of that, there's a lot more sophistication. There's a lot more large groups that are specifically built to manage multifamily, your garden style and up even into your vertical type apartment complexes. When you really look at single family, most of the management structures, especially in kind of these secondary and tertiary markets, they're more mom and pop, type groups. Nothing wrong with it, but they're groups that might manage 30, 50, 100 doors. And so they're not going to be able to kind of have the same approach or the same kind of ability to provide the same tenant experience, the same marketing approach in terms of sophistication. They're not going to have maybe a lens around asset management or some of the other things. So we've always operated and managed our own assets. So if we develop a community, we're managing that community ultimately. What we've realized a few years ago is that ultimately there is a gap, as you mentioned, kind of in how these types of assets are managed. So we've really opened up kind of our playbook to third-party management as well, and being able to take on, anything from a small portfolio of one to 10 homes, all the way up to, larger portfolios in the, 3, 4, 5, 600 range. For some groups. So, being able to provide that management and that sophistication, I think being able to bring the efficiency that's important as an operator is very, very important. I mean, if you think about, as a developer, and we really describe ourselves as developer operators, because I think it's very important and it's a distinction to make. There are a lot of people who just wear that developer hat and they do very well for themselves. They're focused on everything from land through a CO, through a completion of basically construction, right? And then at some point, somebody else is going to kind of step in and actually run the asset. Well, if you look at the whole of a project and the life of a project, the performance of that pro forma, the performance of those numbers, the returns that those investors ultimately get, so much of that is dependent on the execution. So much of that is dependent on the operation of the actual asset itself. And I think if that falls short or that isn't prioritized sufficiently, or there isn't efficiencies in all of that, like we often see, then naturally the asset is going to underperform. So I think that's where we've really kind of tried to, as much as anything else, improve the ecosystem of single family rentals by providing a larger property manager base for the markets that we're in, to be able to provide that even for smaller portfolios. Because the owner of a smaller portfolio everybody starts with their first house somewhere, right? And then at some point, you're adding to that along the way. Those naturally, the idea is to become larger portfolios. And so we would rather, again, be there kind of as a baseline, providing that service, being involved, giving insights around rent growth, neighborhoods, areas to target maybe for future acquisition or whatever else. And also as an asset manager, being able to kind of help say, hey guys, you might have, really gotten your growth here, and this might be a better time for you to take it to market and potentially flip it out and do a 1031 exchange and, sell these houses over here that are maybe getting a little older and buy these newer ones over here. So, having all of those abilities kind of throughout more of a vertically integrated approach, I think does give us the ability to see more from a data point of view, which is often what really is lacking in the single family rental space. Apartments have a very, very deep market of buyers at all different levels. And there's so much more data because there's 30 or 40 more years of history there than there really is in the single family rental space. So we think, again, anything that we can do to improve the ecosystem will ultimately improve the success of the asset. And for us, then that means that there's more transactions, which is beneficial to the whole community.
Yeah, went all the way around. Where all did you say you guys can service at this point for the property management stuff?
For sure, yeah. So our core business has been Kansas City for the last 15 years plus. Core market, Kansas and Missouri both. We have that Midwest presence and that office there in Kansas City. We're also in South Florida, so we've added Florida kind of as of this summer. So both brokerage and property management, and we're kind of expanding outward. We have done most of the work we've done historically in the Midwest, but we can see the long-term trend towards the Sun Belt like everybody else. I don't think I've ever been to, had a conversation or been to a conference where, Sun Belt became like the drinking game of like how many times people mention it. So, I mean, clearly we see where the trend is. We see where growth is. I'm part of that migration. I moved to
Right.
Florida in
Didn't
2020.
mind.
So I get that, people are moving to warmer places. And, ultimately, I think because of that, that's where a lot of the new housing is going to be needed, and where a lot of the new housing is also being built right now. I think you can see that in a lot of these markets. So, we should be by the end of the year across several markets in Florida, several markets in Texas, and then also in the Phoenix Scottsdale market as well to add to kind of our presence in Kansas City.
Nice. Yeah, I knew you guys are had that vision, but in terms of, I think a lot of people in our audience as well, they, like you said, they might be that smaller investor where they are starting to build that portfolio, looking to scale, looking to move and continue to grow that. Is there a certain point, or is there an assessment that you can recommend of when somebody is ready to outsource that property management? Like, how can they think through that process to know, oh yeah, I should bring in a group like you guys?
Yeah, I think you really have to kind of, it's a component of self-awareness like anything else in business or life, where you really kind of want to figure out like what jobs get you excited and what jobs do you want to do.
Mm-hmm.
Being an operator and managing, I can tell you of all the things that we do in our business and all of our businesses, property management is the lowest margin by far. It's not a business that you specifically get rich on. It's a business that really plays a function in the larger aspect of real estate development, acquisition, divestment, price appreciation, all the kind of various different elements that happen in the course of
Mm-hmm.
kind of, building a portfolio or building wealth, which is generally why most people are in this business and should be. That's why, we're all here. I think when you look at that as a whole, if you plan on building a portfolio and managing it as the operator long term, it makes sense to potentially pick up some of those skill sets. If it doesn't, it probably makes sense to go third party with someone that you can kind of grow with as soon as
Mm-hmm.
possible. I said it before. We do bring on small managers, not small managers, small portfolios intentionally so, because we expect that we can also help them in that process become a larger portfolio. So, the end game for us is not to manage a bunch of people who own one or two houses, but it's to establish that initial relationship and know, hey, I may not make any money managing one or two houses for this guy. But at the end of the day, I know that if he's in real estate and he's involved and he's interested and he's learning and he's growing and he's, he sees where this can go, that's going to end up being 20 or 30 or 50 or 100 houses at some point. So
Mm-hmm.
I think the idea again of function is, do you want to learn a skill set that you are only going to want for a couple of years, or do you want to kind of get that off your plate ultimately to a more efficient manager where you can see those efficiencies and then really focus on what makes the most sense? Asset management, acquisition, capital formation, whatever form or strategy or tactic ultimately kind of comes into play, we think that's probably where the individual owner and the individual entrepreneur in the real estate space is better able to put their time. That's where we put our time for the first number of years along the way in building a real estate business. The property management piece was done in some cases out of necessity because nobody had really built what we're talking about and what we're currently building, I think, for the asset class. It was one of those scenarios where, again, you could go get that third party property manager. They were generally, though, in these markets or in these, secondary regions, they tended to be very mom and pop in their approach. They didn't have the software. They didn't have kind of the whole, ability to do significant reporting back to the owner. They didn't have maybe the marketing funnel or stack around, tenant, rent growth. When you're managing stuff and that it needs to perform and ultimately you really, really are kind of pushing, it's a different approach than I think managing stuff in a very passive way where it's kind of like, hey, you know what, it's good. We got, X dollars last year. We're good to get X dollars this year. We're in an environment, and we explain this to property owners all the time. It's not being greedy. It's ultimately you have a responsibility to optimize. When we look at rent growth scenarios and rent is going up like it has over the last few years, especially during COVID, you're not just like, it's an option. In some ways, you're really kind of obligated to push rent because your cost is going to be going up, whether you like it or not. You can not push rent. We've often got scenarios as well where we're working with property owners and they end up with these massive bills around deferred maintenance. And, we're coming into their life and they're kind of wanting to hand all these properties over to us. And we're like, you're going to have to fix a lot of this stuff. Like this stuff isn't up to where it should be at. It's like, well, we haven't really been able to afford to keep our property up. And I'm like, well, it's because you're not at market rent. There seems to be a correlation in that regard. So, I think, again, having someone who's wearing the lens of asset manager, has the experience, obviously, managing their own properties, makes a significant difference. That's one of the real things that we kind of emphasize when we're talking to potential property owners around what we're doing. I think the other side of it is because we also do have a pipeline of new product that's coming online and available. It gives people a lot of options that they may not have had otherwise. To be able to see, okay, what does this look like to buy in this neighborhood, in this school district, new product versus buying maybe in this other neighborhood or this other school district with maybe some older product. There are opportunities all around. It's just, again, a question of kind of how people are optimizing where they want their dollars to flow and ultimately the mix of what they want to own along the way. But, I go back to it all the time. Costs are going up regardless of whether you like it or not. So rent has to go up or else you end up in a situation where your assets are ultimately performing worse than they were before, not better.
Right. Yeah, I think you really touched on it there. I was going to make sure I really ask around kind of, digging into market trends here. But it's something that I know of everyone that I catch up with, Andy. I feel like you're one of the guys who have such a close pulse on the market, very well read in terms of keeping yourself up on that. And like you said, in Miami, you've got, every week a new event in your backyard that you could go to if you really want to network with the people who are making things happen. So I'd love to really end it with this around asking, hey, how do you, again, it's May 2024. How do you kind of see the real estate market evolving? What trends are you seeing out there? How can our audience really embrace change and keep up with that? Like I'd love to just kind of get your perspective on that to end this too.
Yeah, happy to be very opinionated, whether it's founded or not. I think that it was 90 days ago when, almost any economist who could get on television was telling everybody that there was still going to be 5 to 7 interest rate cuts before like June, right? June is like practically tomorrow. Okay. Like there's 0 interest rate cuts, right? Like yesterday, people almost like acted like they dodged a bullet that there wasn't an interest rate increase, right? So, the conversation I was having with some folks yesterday, which, very much kind of fits with this vein is, the embrace of the idea that interest rates are going to be higher for longer is kind of where people are coming around to right now. Where I think we've come to and we kind of are starting to see is this is probably normal. And it's just normal kind of going forward, So I think to bank on any interest rate decrease anytime soon is difficult, and it potentially, I think, creates some risk there. If you just take the Fed at their word, inflation has not been curbed. It's not under control. It's not to the target in any way. And so, we would be surprised if we see interest rates move significantly. So if this is kind of the new normal and you're kind of dealing with what it is, then you have to really kind of try to assess and be a little bit more selective in terms of acquisition, in terms of disposition, in terms of other things. And you have to also know that that's going to cause, higher cost of capital means higher rent because the assets have to in some way pay for themselves. I mean, that's just how this works. We look at these overall trends around affordability, and as much as you would like to see, some, light at the end of the tunnel around, things becoming more affordable, we don't see it. I mean, I think just to be very clear, we are, if you're conservative, 3 million homes less than what we should be right now, just to kind of be at, at stasis, if you will. We're probably closer to 5 or 6 million homes behind in terms of supply to demand, unbalance. I think it's only going to get worse, and I think, again, the more expensive capital is, the less new construction there is. You're already seeing that start to pull back, not just in multifamily, but also in single family. And I think along the way, it becomes more and more difficult for new product to come out there. That then will continue to drive rent upward. Now, short term, you have some markets where you have 10, 20, 30, 40,000 new units coming online. You guys know what those markets are. It's easy to look those up. There may be some pullback on rent, or there may be just some flattening of rents. But long term, those markets still have a lot of people moving to them as well. So I think, that's where you might have, okay, cool, rent didn't go up in 2024, but it started going up again in 2025 or 2026 or 2027 when there was very little new supply coming online. So, I mean, I live, to your point earlier, I live in South Florida. During COVID, stuff was going up 40% a year down here. I know that's not sustainable, but I also know that, it hasn't really come down yet. And I think, you look at a lot of the markets, we like markets where stuff goes up, 4, 5, 6 points. That's a good, healthy rent growth. Candidly, you can live with 3 or 4. But we again don't see anything, at least in the markets that we're in and that we kind of focus on, where population's going up, where you have a pretty good job story, where you have a good quality of life. Those are places people are going to want to live in, and there's not going to be enough homes, and there's not going to be enough homes, whether those are to buy or to rent. And I think that story really will continue to reinforce the increased value with the rent growth story of this asset class. And again, single family rentals, I don't think they're going anywhere. If there's 15 million now, I think over the course of the next 20 years, that's going to increase significantly.
Yeah. I mean, I think for our audience, it really is helpful to kind of think long term like that. I know a lot of them, again, might be in the wholesaling space, might be looking to reinvest that and kind of level up, like we talked about earlier, of continuing to evolve your real estate game. So appreciate you coming on and just sharing so much value with our audience, man, and really giving your perspective on this. We'll have to check in like 6 months again. have you back
there we
on.
go.
We'll be accountable.
Yeah, we'll see if I'm totally wrong.
But regardless, like you coming in and kind of sharing, again, your guys' philosophy, and then also advice on the property management side, something we hear about, or we're asked about often. So really absolutely enjoyed this. It was awesome having you on, Andy. What's the best way for people to connect with you if they want to reach out and connect for any reason?
Yeah, for sure. We're easy enough to find. If you just Google Elux, we come up multiple ways. Eluxcommunities.com is very easily. Rentelux.com is our property management website. And again, I'm pretty easy to get a hold of as well. So, LinkedIn or other places. So, very simple in that regard. And again, my pleasure for being here, and we'll have to do it again soon.
Absolutely. So we'll link to all that below, and we got a few other free resources we'll link to there again. But Andy, thanks again for coming on. Really enjoyed it, man.
Thanks, Matt. Cheers.
Yeah. To everyone watching, this is Matt Kamp over here with DealMachine, and happy deal finding.